So we will start. Dear friends, we are thrilled to invite you to an exclusive online session unlocking corporate venture capital opportunities and strategies for startup growth. I am Nitin Agarwal, Senior Director at Delhi-NCR. For those not familiar with TIE, since 1992, TIE has been supporting entrepreneurs by offering education, mentorship, networking, and funding opportunities. Mission has been to foster entrepreneurship globally through the 5 pillars of mentoring, networking, and education, funding, and incubation. Dedicated to the virtuous cycle of wealth creation and giving back to the community, TIE's focus area is to generate and to enable the next generation of entrepreneurs. Now, coming back to the topic, the session will cover the corporate venture capital and its differences from the traditional venture capital firms, focusing on how established corporations invest in startups. It will discuss CVC avenues in India, notable examples, the engagement models. You would also get to learn key considerations on how to engage with CVCs and the right timing for involvement. The session will also highlight India's increasing presence in the global CVC landscape. And ladies and gentlemen, please allow me to introduce our speaker, Ankit Harjai, Chief Investment Officer, Mount Growth Fund. Ankit brings over a decade of years and expertise in venture investments, mergers and acquisitions, business incubation, and product launches. He holds an MBA from IIM Lucknow and a BE honors in electrical and electronics engineering from BITS Pilani. Ankit has further fortified his knowledge with certificates in capital and financial markets from IFT Delhi and impact investing from Thunderbird School of Management, Phoenix. The stage is all yours, Ankit.
Thank you, Nitin, for that introduction. If it is audible for all, I'll start presenting my screen.
Yeah, please.
Let me know if the presentation is visible.
Yes, it's visible.
Sure. So we'll start with today's topic around corporate venture capital. So I'll be more or less coherent with the 5-6 line items which Nitin had earlier shared. In the hindsight, I will also request the participants to share their questions with the team here itself, so that we address those questions maybe at the slides or maybe at the last. There's a short quiz at the end of the presentation so that all the participants also get a chance to test their knowledge, whatever they could grasp during the presentation. So moving on, I'll just draw a picture of the Indian VC landscape right now. How is it looking like, and what sort of different players are actively participating right now. The early stage ecosystem is quite vibrant in India, with a number of venture capital funds, right from Chirate to a number of VCs which are applicable across sectors. Be it your consumer internet, be it your deep tech companies, there are a good number of VCs now which exist in the early stage ecosystem. Then there is a middle pie of around growth stage investors, which generally are global marquee names, including your Axels, Peak 15, Tiger Global, Bessemer Venture Partner, and Lightspeed. So these VCs have been operational in India for more than a decade and have been participant in the India growth story so far. What I see that right now there's a lacuna which exists in the late stage investing, and even potentially the companies which are like the strategic exit buyers of all these companies or startups. In India right now, most of the late stage companies, which include Baring Private Equity or SoftBank and a few other private equity firms, are now actively participating in the late stage VC journey of all these startups. But still, there's a quantum of, I would say, a good number of investors which are required to participate in the late stage round. And there's an opportunity for all these corporate venture capital firms to participate. So I was previously heading the CVC arm at Cummins in India before joining out in my current role as a CIO with Mount Growth Fund. So in my previous role, I was looking at all the opportunities which a CVC would be looking at from their core product standpoint. Cummins as a brand, it was focusing around automotive energy, all these applications around energy related products. And as a CVC, we also saw that all the early stage as well as the growth stage firms were not, you can say, looking at the late stage investing or the post growth stage kind of investing. So there was an opportunity for a CVC to exist as well as participate in the Indian ecosystem. One aspect of late stage investing is you take those companies and potentially acquire them. That's the strategic exit, which generally happens. Second is how you mature those companies into profitable models is something which a public listed company can easily help you with, and also help those companies to do a lot of SME IPOs. So Cummins as a brand was potentially focused on getting a lot of these companies to list on the Indian Stock Exchange. Some of the notable examples are KPIT. KPIT Cummins was an ERD company, Engineering Research and Design Consultancy, which listed on the Indian Stock Exchange in 2013. And Cummins India realized a lot of benefits from it. Then, similarly, a few other companies have been listed by Cummins USA. There's a filtration technology company based in US called Filter Technologies NYSE. So they have got listed in May last year itself. So a number of good companies can easily be housed inside a CVC and can be taken to the market at least at a public market level. So that is something which any of the growth stage investor may not be able to do, but a corporate entity would be able to potentially do it. So that's how we are looking at late stage investing. Now looking at the India landscape, considering the overall ecosystem to be, I would say, maturing at this point of time, where all these late stage investors are taking India more seriously in terms of a market where they can get a potential technology which is global in nature or maybe scalable in nature for a large number of foreign clients. So for those kind of corporates, this late stage investing is becoming more attractive. And lastly, the M&A deal desk of all these CVCs generally works separately from the CVCs because their mandate is more from an acquisition standpoint. And the investing landscape is a bit, I would say, also shaping up quite well going forward. If there are questions, please do add in the Q&A. And Nitin, I would suggest if there are questions related to a particular slide, maybe I can address it immediately. Moving on, starting with a basic definition of a CVC arm. A CVC is generally a corporate how they tend to invest from the balance sheet. Most of the CVCs in India tend to not have an AIF structure in place. Generally, AIF 2012 foundations or requisites are required when it comes to AIF registrations. But a CVC generally invests out of their balance sheet investments, and they prefer to take significant minority stakes, as well as look at from a tech returns, or I would say strategic returns standpoint, where technology occupies a core focus area for any of the CVCs, followed by the financial returns. So financial returns definitely occupy a second focus area for a CVC as compared to traditional. So that's the difference, how a CVC looks at all these applications. Second is when you are checking what kind of a difference exists between a CVC and a traditional VC, always look out for the strategic goals of a CVC as well as the interest of the parent corporation, what they are looking at. So if I take an example of companies like InfoEdge, their focus will be digital and media largely, except for a few deep tech applications that they are also investing these days. For a company like Cummins, it will be primarily focused on auto and energy because they are the core product focus areas for the organization going forward. Lastly, when I look at the CVCs, there is a huge upside tick when it comes to participating with the CVC. It's generally around innovation practice, your access to the internal tech, which the corporate would be having. And lastly, will be the market expansion or the GTM strategy build-up for all these large corporates, because corporates, because of their age-old history of running up a business more profitably as well as across different geographies, they are able to get access to a number of, you can say, customers, which can help in the startups early stage growth as well as getting them to a product market fit faster. That's something which I have seen at least for a few companies which we have looked at from filtration technologies at Cummins as well. Going forward, when I look at CVC as a strategic tool, most of the large corporates which are looking at creating their own CVC arms, they tend to create some form of a cushion or a margin of safety when it comes to investing as well as gaining out of the startup investments which they are trying to make. Because at the end of the day, they are looking at potential technologies which are creating some form of a new category or maybe creating some form of a new product line for the corporate. That's how a CVC looks at investing, at least from the initial bit. At a later stage, they may be more interested towards the financial returns out of it because uh, they would be interested in realizing financial gains as far as the shareholders' focus area is concerned. So that's more concerned for a later stage whenever these technologies mature as well as they are taken to the market more faster. Looking at the overall strengths of a CVC, all these CVCs tend to be product companies, so they understand a lot of these new technologies as well as understand the benefits of a partnership very early on. So when you take a CVC on board, the large benefit of a startup would be getting access to these more mature product lines early on so that your technology can fit in and also find some form of a suitable use case. Second will be key stakeholders who come from the ecosystem. You can only engage with them via the partnerships mode. So that's one benefit which a CVC can add, at least from the apart from the capital which you are getting in. Second bit is a CVC may or may not be helpful for you, at least from a short-term gain realize. If you're looking at only capital, they may not be the right partners for you. The traditional VCs would be a good partner because they generally fall on the category of patient capital or balance sheet investing, which they would not like to realize at least in the immediate 2 to 3 year timeline. So that's how a CVC tend to look at investing into the startup. From an opportunity standpoint, definitely a CVC, when it is trying to engage with a startup, they are trying to focus on the innovation side of things, new age technologies, as well as getting some form of a moat in the product line, which is missing right now. Because most of the time, a CVC is trying to evade potential threat to the overall organization. Like if they are trying to get some form of a competitive advantage in a energy related product, they would be trying to get some form of a new age, either a form factor or it can be a use case which is non-existent right now. For example, hydrogen as a use case is very new to the India market, and potentially any startup which is building out a hydrogen application would be a good fit for a energy related CVC going forward. Now looking at the threat which CVC can have towards the startup environment, largely it's because of the nature of the organizations. These organizations may be far and few in terms of uh, regularly coming to the market and investing. So the frequency of visit of a CVC to the market to invest is very limited, and they also sometimes have a very much slow process as compared to a traditional VC. A traditional VC will be more fast in terms of realizing the opportunity to invest, and they also do not have the long list of, you can say, approvals which are required when it comes to traditional VCs. Now looking at the internal perspective, how a leadership at a CVC would be looking at these kind of businesses. Firstly, it is the strategic alignment of a CVC with the corporate, where generally the long-term strategic gains or focus on one of the business areas is generally aligned for the leadership while they look at a CVC. Second is the risk return profile. Generally, the risk return profile for a CVC is somewhat lower than the traditional VC because they are trying to hedge it against the tech acquisition, because they are looking at potentially using that technology to augment their own product line. Second is how they are looking at getting to a growth path, because most of the time the corporates have gone through a cycle of low growth or maybe cyclicity. That's why they are trying to invest into these early stage companies just to realize faster growth as well as gain some form of a moat going forward. Lastly, a challenge which exists with the startups while working with the CVC is cultural integration. And obviously, when you acquire out a startup, it's a people issue or maybe a integration issue, which generally happens. But a CVC generally helps the leadership teams at all these corporates to keep the startup engaged with the corporate, but also have some sort of a arm's length approach. That's something which CVCs tend to offer when it comes to working with the startup, which is missing, at least from the M&A route, which most of these startups tend to take while getting acquired by the larger corporates. That's how a leadership is looking at from internal standpoint. It should be strategically aligned with the corporate. It should have a medium risk return profile, as well as it offers some form of a integration with the main product line going forward. Now, looking at the different engagement model which a CVC tend to have at a global level, there are some examples which are Indian in nature and some examples from the global corporate. So generally, the engagement with the CVCs have are typically bucketed into three types. One is a standalone corporate innovation fund. Second will be a corporate innovation fund plus incubator. Then there are some CVCs which have an ecosystem play where they are present across the value chain as well as distributed across different user bases, which includes your accelerators, your incubators, your VC arms, and also late stage investing or private equity. Now, looking at the standalone corporate innovation funds, all these companies which are looking at the growth to late stage startup, they may not be aligned with the core business. They tend to start up these CIPs, corporate innovation programs, especially the likes of Marico, Shapoorji Pallonji, Pidilite. They have their own standalone corporate innovation funds, which frequently have invested into the Indian startups. The deal volume for all these standalone corporate innovation funds is medium in nature, less time intensive, and generally 2 to 3 resources are looking at. So these are very senior folks. It can include your CFO or maybe your chief information officer who would be looking at these standalone corporate innovation funds and managing the deal flow review process, as well as the deal execution process for all these funds. Now, looking at the middle model of corporate innovation funds plus incubator, this approach is the most commonly followed approach when it comes to the innovation funds, and it generally deals with the early and the late stage startups. And as you would have seen in the Indian ecosystem, Shell has its own ventures arm as well as its incubator. So they are fairly actively using this innovation fund plus incubator model, at least in India. L&T also has an innovation fund, plus they have recently signed up a few innovation partners as well. Volvo Cars, which has its incubators in the valley as well as innovation fund. The deal volume generally is very high because you are dealing in the early stage to late stage companies. So the deal volume tends to be very high when it comes to this middle engagement model. It is quite time intensive in nature, and it also involves a lot of people. So roughly 4 to 5 resources generally go into these kind of fund structures to manage the deal flow engagement reviews as well as execution going forward. The last approach is more comprehensive. There's one Indian enterprise, luckily, which is doing this, but there are a few global corporates, especially from EU, who are also doing this. The ecosystem play is a more holistic play where you not only deal with the deal and early stage to late stage deals, but you also involve multiple stakeholders in your ecosystem. And it's largely an organization which is like a conglomerate, which can easily accomplish this. Deal volume again is very high. And obviously, considering the intensive nature of these kind of engagements, more than 10 resources are generally required in this case. So Aditya Birla Group is engaging this. So I have another slide which shows how the value chain is looking like for them. Lego Group in Denmark. Now, looking at the 3 innovation models, when you look at the Aditya Birla ecosystem, you have 4 buckets of participants here. You have a accelerator, which is generally run by their student community. Then you have an incubator called PIDES, which is Pilani Innovation and Entrepreneurship Development Society, which is their AIC or incubator. Then they also again have a corporate innovation fund called ABG Innovation Fund, followed by their private equity arm called Aditya Birla Ventures. So that's how a conglomerate can tap into the different value chains as well as engage with the different participants at different stages in this approach. Now, looking at the examples of standalone corporate innovation funds, you have Shapoorji Pallonji, Pidilite, Sharp Ventures, Cummins used to have these standalone corporate innovation funds. Now, lastly, looking at the fund plus incubator, a few examples are here, like Campex is one of the incubators of Volvo. Larsen and Toubro had some engagements with the incubators which ran L&T EduTech. Again, Shell Ventures has Shell E4, just for your reference. Now, looking at the overall landscape, how CVC tend to source all these companies. So there are multiple sources how a CVC would be sourcing these companies, which includes your corporates, corporate innovation funds, academia, their research labs, or even the government research labs as well these days because of the government's push on private public partnerships as well. Incubators, accelerators, and a certain set of platforms. VC, private equity, family offices, and wealth management institutions are also a source for CVC. Databases, hackathons, as well as industry forums. But looking at the overall frequency, corporates, academia, and incubators occupy the higher chunk of volume, roughly 60-70% of the overall deal volume. Private equity firms also send out a number of portfolio firms to these firms for acquisitions as well as investments. Lastly comes the thought leadership as well as the reputed agency reports. So they occupy the least, the rest of the 30% of the chunk when it comes to building up of a deal pipeline for a CVC. And generally a CVC look at their overall idea hopper more frequently at a monthly level before they take it to the IC, at least for the top leadership to take them for other considerations. Generally, a CVC does the balance sheet investment. That's why they tend to not follow the AIF structures because you require independent regulations. Plus, you need to set up your own set of trust going forward. But just explaining how a CVC is able to manage it from its balance sheet. So CVC tend to take in the money from their corporates directly from the balance sheets. Later on, the CVC fund takes that capital pool directly deploying into the portfolio. Again, the cyclicity is like that, where whenever there is a financial gain from a portfolio firm, the capital is returned back to the corporate. That's how the cyclicity of the fund is maintained, and you do not have that kind of a 8 to 12 year cycle, which generally the AIF 2012 regulations will ask you to do that. So a CVC has that flexibility as compared to the traditional VC funds. Now, looking at one case study which I have, at least for the India market, uh, everyone is aware of InfoEd's case studies around your Policy Bazaar as well as Zomato. But looking at their overall structuring of the funds as well as how they are now independently doing the AIFs, this shows that even the corporates can look at the AIF model if they are creating value for their shareholders in terms of getting them to access to quality companies via the private markets through that. Looking at InfoEdge, definitely their corporate balance sheet investments into the Zomato and Policy Bazaar resulted into quite a good financial gains, multi-baggers going forward. Similarly, the parent organization still holds around 20 active portfolio investments going forward with a total book value of around 520 CR. This number may be off because of the recent filed numbers, but mostly it should be in the ballpark range of 500 CR. The major investee companies from them also include Shop Kirana, Shipsy, Gramophone, Adda 247. So all these investments stand to show that there's a huge value gain even for a corporate when they are looking to participate in the private market going forward. So that's how the value can be unlocked. Now, looking at the other two funds, which Info Edge Ventures and Capital 2B are running. They are also fairly successful in terms of creating their own set of portfolio firms. Looking at Info Edge Ventures, you are looking at Fund 1, which is 200 million, and Fund 2, which is another 150 million. Their portfolio is also again focusing on the organization of sectors around your supply chain as well as smart procurement, followed by another set of software companies. Capital 2B is somewhat a divergent to their overall focus area, where you are trying to invest into deep tech. So that's a offshoot when it comes to a corporate trying to invest into deep tech, which is not a core area for them, but it generally happens in the long run when you are looking at new age sectors where the alpha could be followed as well as more returns could be realized in the longer run. So they have invested into electric energy as well as energy storage related applications going forward as well. So overall, InfoEdge is one of the standardized, I would say, case studies, at least at a global, not at a India level, but also at a global level, where they have created successful corporate balance sheets, plus also carved out case studies when it comes to running up independent ventures going forward with a sizable sum of around $425 million. That's how we are looking at a CVC model. And looking at the global landscape, only a few CVCs have been able to create this kind of a legacy. Most notably, Schneider Electric Ventures is one of them. Then there are a few investee companies of N Ventures, which is NVIDIA's sister concern as well. So there are some global case studies which are getting developed, but they are not as successful as InfoEdge. That's a outlier I just wanted to highlight here. Looking at the other CVCs, which other companies are creating across the sectors. So this CVC phenomena is not only restricted to energy or auto, because these are deep tech applications, but other sectors are also looking at investing into startups. Especially you look at J&J, which is into healthcare, Lufthansa, which is into airlines, Rabobank, which is into financial services for the underserved market. Then BASF is a chemical company which is focusing on the your fertilizer industries largely. So they are also running up their own incubator. Volvo coming in from the heavy equipment background. They also have their own innovation lab, which is based in Valley. So it's a comprehensive CVC landscape. These are just a few examples which I wanted to cite. And most of these organizations have created a strong legacy in terms of their portfolio of at least 10 to 15 companies with their following. Now, looking at the overall global foray, which is looking to invest into automotive. So there are three buckets under which largely the VC or the large corporate CVCs are investing. These are software applications, mobility applications, followed by electric vehicles and automotive manufacturing. So these are the marquee names, including Samsung Catalyst Fund. So it's again based in Korea. Samsung Automotive Innovation Fund. This is America-based fund. SoftBank and Amazon's Climate Pledge Fund. So they are investing into software applications, at least on the automotive side. On electric vehicles, you're looking at a bunch of applications which are getting funded by Manev Mobility, Tandem Ventures, Autotech Ventures, Frontnalis Partners. Frontnalis is actually one of the investors which is looking at the dealership business. So not only the tech businesses are getting funded, but also the traditional businesses which are getting automated, at least on the dealership side, they are also getting funded by Fontanalis and GM Ventures. GM Ventures of late has offloaded its portfolio because of financial concerns, as well as one of their sister companies filing out for bankruptcy. So GM Ventures has moved out. Now looking at the automotive manufacturing, Jaguar is doing a fair bit of manufacturing related investment again in UK. In Motion Ventures, BMW I Ventures, followed by the consortium of Renault, Nissan, Mitsubishi. They are doing fair bit of investments in Japan. Toyota Ventures is also active in India. They have made one investment in a company called River, if I'm not wrong. Now looking at the items which a startup should check before taking any form of engagement with a CVC. So whenever a CVC is trying to engage, they are mostly looking at equity financing route, but there are few CVCs which are fine with the debt round as well. So as a startup, one should be checking about the flexible financing options, or maybe check with them whether they are also helpful in terms of getting the companies to list, because you require a number of regulatory as well as revenue related guidelines to be met before getting them listed. A few CVCs do help on that. Global network, access to major global US India corridor or maybe Middle East markets. That is also something which a CVC would be able to help. Lastly, looking at engineering talents, a CVC coming from a product background, they tend to be accessible at least to the engineering talents or maybe in-house experts. That's how a CVC is a bit different from a traditional VC, where those engineering experts can help you get access to some form of a consultation, just like a bank of ours, which is similar to credits, which one tends to get from the larger organization like AWS, etc. Fourth will be a few CVCs have a very strong engagement with the governments when it comes to public sector relations. So if your startup is building anything on the public sector or government relation or GovTech, I think in those scenarios, it may be helpful to engage with a CVC just to get access as a business partner. Then comes one-to-one coaching. Some of the senior leaders of these CVCs actively engage with the startups just to add BD capabilities, maybe partnership building capabilities, or add some form of a tech capability going forward. Looking at the overall structures, some CVCs also do interactive workshops, events, build up the technical know-how for all these organizations, followed by any form of a market insights that they would have. Lastly, some of the CVCs have taken a very different model where they are also looking at providing co-working or free working spaces as well. Uh, for example, TDK Ventures in Bangalore has set up a workspace, especially for the deep tech startups which are working in the material sciences. Looking at the last few items, helpline support, where a dedicated support or an engagement manager is generally given out by a CVC to a startup. There are few CVCs which do this, especially Shell Ventures. They have a concept of a implementation manager, which generally works with a startup and getting them engaged with the internal stakeholders. So that's very hands-on approach or a operator-led approach when it comes to supporting the startups. Lastly, looking at a few organizations, they tend to have active engagement with your hyperscalers, including your Azure, AWS, etc. So they may have access to the cloud programs or any of the marketing tools. So do leverage that. So these are some 9, 10 items which I would like the startups to consider, at least while looking at a CVC for engagement. They can look at these aspects while engaging with them and see if you are able to get access to 7 or 8 of these points. I would suggest take money from those kind of CVC. That's how I look at the overall engagement model. Maybe we can take some questions now.
Yeah, I think there are two questions which have come. One of Ashutosh, what is the minimum size of CVC deals, both in terms of revenue or employee strengths?
The minimum size of CVC deals again is dependent on the nature of the organization, where this particular organization is trying to invest. Like for auto and energy, the typical deal size which they would be looking would be in the range of almost $2 to $5 million. That is like a Series A to Series B kind of a check. But for few deep tech applications which may be working in the space tech, the check size would be required to be a lot higher.
I think then there's another one by Harshvardhan Kothari. Are CVCs linked only to their products? And if CVC is a private company?
CVC generally are housed under the same corporation. So a CVC would be sitting in the same public limited organization, and they tend to invest from the balance sheet itself. So for them, they are open to invest into private market organizations as long as the product line is aligned. Secondly, when you're trying to invest into related parties, you sorry, related companies, you also tend to check on a lot of synergies, which would be required at least from a filtering standpoint.
Manveen has this question: CVC relevant for fintech?
CVC relevant for fintech. If I recall, BharatPay had one investment section. They had one team member who was looking at investing. Then from the listed players, Paytm also had an investment section, but they are not doing that well, at least from the current scenarios as well. From a global standpoint, Stripe is one. Stripe has a VC arm. PayPal Ventures. PayPal Ventures is very active in the EU market. Then MUFG is also there. MUFG is a subsidiary or a fund related to Mitsubishi. So these are 4, 5 funds which one can check.
Right. Kalyani has this question: how is IP handled once we co-develop? What's the best strategy for a startup?
On the IP getting developed, I would say if you're doing a co-development, you should take active ownership in terms of patents getting filed in the name of the company itself. So that's I would say, hedge for you. If in case the future deployments or maybe any large bulk order comes in from any other company, which is not your investor right now. So I would suggest getting your IP in your name would be the best policy from a startup standpoint. If you're doing any co-development, in some cases, PSUs, especially in India, they do co-development with the PSUs, but PSUs tend to keep some form of a royalty charge. If it is a royalty charge based engagement, I would suggest you can go ahead, try and keep it as minimal as possible because you do not want to give out a large chunk of your revenue uh, in case the product becomes a blockbuster for a period of time and you're doing hundred of millions of sale and maybe giving out 1% of that sale as a free money to one of the larger corporate. Try and minimize your royalty charges as well.
I think Ashutosh has a follow-up question, and that's: so is this not for early stage startups? Have you seen any pre-revenue with tech or small revenue with tech in CVC deals?
Pre-revenue, very few deals would be there. Small revenue companies, definitely they form a part of the overall pipeline for the CVCs. That is applicable for them. Secondly, from a actual market fit, any company which has a product market fit, where you have got some form of a demo order or maybe a deployment with a large client. For those kind of companies, it's a good fit for a CVC because a TRL 5 and a 6 company where you have tested your product either in a controlled environment or you have deployed them in a market scenario. For those kind of companies, a CVC is a good fit. We have actually participated with a few companies which are actually doing RECDs, retrofit convertible devices for capturing the particulate matter for a few engine applications when I was with Cummins. So for them, the focus was at least there is a product market fit and we need that product in the market immediately. So CVCs also can accelerate sometimes.
Chaminder has this question: can a tech-enabled startup with pet services platform approach a CVC at MVP stage?
Pet services. So your categories is altogether very focused where you are already providing pet services. So I am not aware of any large corporate which is doing any investment directly into pets related product. Maybe in your case, partnerships may be a better mode when you're trying to uh, increase up your overall market share when it comes to services. So maybe signing up a large chunk of these product companies which are already having their offline presence. For example, Heads Up for Tails has its offline presence in terms of its stores. Then there are a few vet stores as well, which are doing direct access to the veterinary doctor like Vetic. If I recall, and if I'm not right, the name of the company was Vetic, VETTIC. For those enterprises, I think partnerships may be a mode. Capital, I'm not sure whether a CVC is there, at least in this particular segment. Maybe you can check for a few EU-based CVCs which are actively engaging, but not sure of the names exactly right now.
Friends, any other question?
If the questions are complete, maybe we can start with the quiz. So there's a short quiz which I have with 5 questions, and uh, probably we can announce the winner at the end of it.
Sounds great. So would you like to go ahead and post it on the
Yeah, I'm just doing
chat?
that. Let me know if the screen is visible.
Meanwhile, Ankit, there's a question of Shubham which has come in. Could you talk a little more about pre-rev stages?
Just give me a minute.
Yeah, sure.
Yeah, pre-revenue. What's the question?
Could you talk a little more about pre-revenue stages? Shubham Banerjee.
Okay, CVC tend to just avoid the pre-revenue stage companies, at least till the time they have not realized any form of PMF, because most of the time a CVC is actively trying to invest into a tech company which has shown some form of attraction. It may not be revenue, but maybe some form of a customer voice or a feedback. Like, for example, Cummins was a large engine supplier to the armed forces. And if there is an application which goes on top of that particular engine, and armed forces are wanting that particular product to be linked with that engine, so there is a push for that CVC to invest into that kind of a smaller and application and maybe acquire it going forward. So those kind of applications still make sense, at least from a pre-revenue standpoint. At least they should have reached some form of a PMF. So that's something which I wanted to highlight.
There's another one, future of CVC in AI startups and any famous deals involving AI startups.
I'm not aware of the immediate AI related deal which a CVC would have done. If you want to check the CVC details, I would suggest just check for the Google Ventures GV or Amazon. These two enterprises are very active right now, and Microsoft again has invested into your OpenAI. And for your information, Infosys had also invested as a part of its grant program, research grant program to OpenAI at one point of time. So there's a quite a good work which our Indian IT talent at least is doing, at least on the AI front. So there may be a few examples which I'm not aware right now.
Yeah, there's a big question which has come from Mr. Rao. I have a new invention in hydropower generation at the place of need, like a village, town, or industry. We need seed fund to complete our 2 megawatt commercial pilot project. Our method is attested by IIT Madras and IIT Bombay. Are there any investors for such projects?
Yeah, traditional VCs you can check with Avana Capital, and on the CVC, Shell E4. Right now, the stage of the company seems to be right for Shell E4, and Cummins would also definitely be participant there. But there's a partnership between Cummins and Shell E4.
Any other questions before we begin on our quiz? What's the best CVC for a design collaboration tool platform?
Fine. I would say the best play would be Microsoft in that M12 Ventures, because uh, for design tool companies, you have applications from Canva, Adobe, but Adobe has not a CVC, but they have an investment team at their global office. They also hired someone in India as well recently, just to lead those investments. So check on Adobe, Canva, which is based in Australia. They also have a M&A team, and Microsoft. These three CVCs come to my for it. So you can scan this particular code, and the game pin is there. As the players will get login, I'll see those names, and then we can start.
Guys, please go ahead. Let's have some fun. Ankit, am I permitted? Be
Yeah,
part
yeah.
of the game?
Please join. Please join. I think we have enough room, so 40 participants are easily allowed in one go. So we have one election league as well. Let's wait for a couple of minutes till a sizable number of people are there, because it's a time bound. Only 20 seconds per questions are needed. So we'll quickly close it off.
I think we can start, right, Ankit?
Sure. I'm just starting it out. So 4 folks have answered. Yeah. So the right answer is all of these. And Nitin, you are on the top. So other people need to be a bit faster. So in this game, one has to respond faster just to gain more points. Starting with the next. Which of these stage investors are limited in India? Seven folks got it right. Late stage investors are limited. Only a handful guys are there. That's why CVCs are looking at that pie. So we have Amit here. Amit is on top. Nitin, you have moved down to 4. The next question. Which of these is a database? It's quite a good number. CB Insights is a database. It's a database started out by Mr. Sawal. He's another Indian entrepreneur of Indian origin, but based in New York. So he is building up a overall curated list of startups at a global level. So do check out this platform. I really like their insights, at least from a reading standpoint. So Mayuri has got 3 correct answers in a row. Dosh is at number 3. I hope Mayuri comes out on top. Amit, I think you are giving out a good competition to Mayuri here, and Arun as well. The fourth and the second last question, which one of these is not an investment of InfoEdge? People are well read. They at least know the Indian ecosystem. So Shadi is not an investment of InfoEdge directly. And obviously it's owned by Mr. Anupam Mittal. Amit is still on top. Amit is keeping a good pace. Mayuri now to number 2. Gaurav is the highest climber. So kudos, Gaurav again. Let's see who is the final winner. This is the final question for all of us. When should one get strategic investors on cap table? So I have highlighted this point multiple times. People have been very attentive. So 8 folks have got the answer right. Product market fit. Let's see the leadership board. At number 3, it's Vipul. Amit at number 2. Mayuri, if I know. Yeah, so Mayuri is there. Congratulations, Mayuri. Ashutosh at number 4 and Gaurav at number 5.
Thanks, Ankit. This was really interesting. And I think in between there's a question of Arvind also, which has come in.
Sure,
What's
sure.
the
We
best
can
strategy
address
to
that.
approach CVC and get their attention?
Best strategy approach CVC and get their attention. For this particular question, well, you are trying to engage with a particular CVC. Firstly, just check through the portfolio organizations which they have already invested in. Second is when you are trying to get access to any of the CVCs, get their attention via one of the portfolio firms. That's the best way a CVC would try and engage and also get you the due time. Because most of the time, this industry works on references, and that's the best way you will get quality time with any of the partners who are working at these CVC. Secondly, getting attention from the leadership team of these CVCs. Like if you have a CVC at a large parent corporation, connect with their executive officer or maybe the CFO. That's also a good way to interact with them. So these are 2 approaches which I would like to highlight. And most of the time, people have highlighted their email generally via their LinkedIn. So, dropping in a short note to them, getting a face to face time is the best way to introduce your company rather than just cold emailing or sending out your pitch deck via the in-mails of LinkedIn, because most of the time the in-mails are not read. That's something which one should look at. And there's also a research that how many in-mails are getting opened at on LinkedIn. So the numbers are very less.
There's one more by Gaurav. Any suggestions, CVC, for a recruitment marketplace?
Okay, I think InfoEdge stands out a bit, at least in the Indian market, when it comes to the recruitment landscape. Just check whether your product line is in competition with them or a bit complementary, because IamJobs was also acquired by InfoEdge very recently. So just check on whether there is any complementarity or you are just in competition to them. At a global level, I would like to name a few global investors like News Corp. News Corp is based in US, so they do invest into these digital media companies. Do check their CVC applications. Second one will be uh, your likes of Monster, but all these global organizations like Monster, Jobs Ahead, and Indeed as well, they have gone through a lot of recent retrenchment. They may not be looking to do capital investment directly. Just check how their teams are placed right now. I'll repeat the names: Jobs Ahead, Indeed.com, and News Corp.
Any other questions? Else we would bring the session to a close. Thank you so much, Ankit, for taking your
Same here.
time to do this session for us. This was quite very enlightening. Corporate venture capital, we all wanted to know more about it, and this was a great platform. And thank you so much for making it very interesting to have this Kahoot game we all played. And congratulations, Mayuri, for winning it, and everyone to be a sport, be part of this small game what we had. Please send across your feedback and comments as to what would you like to see from TIE as your next activity or a topic we like to take up with. And we would look forward to having Ankit yet again for another session sometime very soon. Thank you, everyone, and a lovely evening. Bye.
I just wanted to end this note with a thank you to TIE Delhi-NCR and also to the TIE overall community to participate here. I'll also mention that this is one of the largest group of people I have tried to address. I hope I addressed it well and added some value to the participants going forward. Thank you.
Thank you.